there, and welcome. So, if you're a business owner who also dabbles in the stock market, you know it can be kind of tricky getting those two worlds to play nice inside your accounting software. Well, today, we're going to pull back the curtain on stock market accounting in Tally and turn all that confusion into crystal clarity. Let's dive right in.
I mean, does this feel familiar? You're buying shares, you're selling them, but when you sit down to actually record it all in Tally, it just feels like a total black box. It's a super common problem, and it almost always leads to major headaches down the road, especially at tax time when you're trying to figure out what's a short-term gain versus a long-term one.
But don't you worry, we've got a super clear roadmap for you today. First, we'll cover the basic tax stuff you need to know. Then, we'll do a simple one-time setup in Tally. After that, I'll walk you through recording your very first trade, and then how to book your profit or loss. And finally, the best part, we'll see how all this hard work unlocks some seriously powerful reports. Okay, first things first. Before we even think about opening Tally, we've got to get our heads around the basic tax rules. Why? Well, because these rules are going to tell us exactly how we need to set things up in our books to keep everything accurate and, compliant. So the very first thing to understand is that the tax folks see your trades in two totally different ways. On one side, you've got intraday trading. That's when you buy and sell a stock on the exact same day. That gets treated as speculative business income, and it's taxed at your normal income rate. But if you hold that stock for more than a day, it falls into the capital gains bucket, which has its own set of special tax rates. Now, for our purposes today, we are focusing entirely on capital gains from these delivery-based investments. All right, so let's zoom in on those capital gains. There are two flavors you absolutely have to know: short-term, or STCG, and long-term, LTCG. And the magic number that separates them? 12 months. Simple as that. If you sell a share you've held for a year or less, that's a short-term gain, or loss. Hold it for one day more than a year, and boom, it becomes long-term. And that 12-month rule is the exact reason why tracking the date and quantity of every single trade in Tally is so important. Okay, theory's done. Time to get our hands dirty. Let's jump into Tally and build a simple foundation. The best part is, you only have to do this once, and it's going to make every entry you make from now on super easy and clean. It's just 3 quick steps. First, in your F11 features, we're going to turn on Maintain Multiple Godowns. Just think of this like telling Tally, hey, I need more than one warehouse for my stuff. Step 2, we're going to create a special virtual warehouse just for our stocks. We'll call it our Shares Vault. And here's the secret sauce. We'll enable this setting third-party stocks with us. And finally, step 3, we'll create the ledgers for each stock, and we have to make sure that inventory values are affected is switched to yes. Seriously, that one little setting, third-party stocks with us, is the whole key to this entire system. It's what lets Tally track the quantity of your shares without messing up your main business inventory. This one click keeps your investment portfolio totally separate from your company's profit and loss statement. It's what keeps your financial reports clean, accurate, and meaningful. All right, our foundation is built. Now it's time for the main event, recording your first purchase. We're going to take that complicated-looking contract note your broker sends you and break it down into a really simple, logical entry in Tally. Now, I know that contract note can look a little intimidating with all those numbers and fine print, but don't worry, you can pretty much ignore most of it. You're really just on a treasure hunt for 4 things: the name of the share, how many you bought, the price for each one, and the grand total of all those little charges like brokerage and taxes. That's it. We're going to record this purchase using a simple journal entry, and the logic is really straightforward. Just think of it in 2 parts. First, we record the thing we got, the shares. And second, we record what it cost us to get them, all those little fees. So part 1 is recording the asset itself. In our journal entry, we're going to debit the ledger for the specific share, let's say Ashok Leland. In accounting speak, a debit here just means an asset is increasing. So we're simply adding the value of these new shares to our books. Part 2 is accounting for all those transaction costs. So we'll also debit our expense ledgers for things like brokerage fees, STT, all that stuff. Just think of them as the necessary costs of doing business to acquire our main asset, the shares. And to finish it off, we do 1 credit to our broker's ledger for the total amount of the transaction. This credit just shows that we have a liability. We owe our broker money for making the trade. Now our debits equal our credits, and the whole entry is perfectly balanced. Okay, so you've bought some shares, time passes, and now you're ready to sell. Recording the sale is pretty similar to the purchase, but there's one extra, really crucial step we have to take. We need to officially book the profit or loss to close the loop on that trade. Right after you've made your main sales entry, you need one final quick journal entry to make the outcome official. Think of it like this.
If you made a profit, you're just moving that money out of the shares account and into your capital gains account. If you made a loss, you do the reverse. This is the entry that officially zeroes out that investment and puts the final result on your books. And now my favorite part, the payoff. All that careful work we did wasn't just for the sake of good bookkeeping. Nope. It was all so we can unlock some incredibly powerful reports that give you real, actual insight into how your investments are doing. This is where it all comes together. This is the moment Tally transforms from just an accounting tool into a genuine command center for your investments. See, the goal was never just to record transactions. It was to get to a point where we have actionable intelligence at our fingertips. Check this out. The first and most useful report is the stock summary. Remember that special shares vault we created? Well, now we can filter this report to show only our investment stocks, completely separate from our business inventory. Look how clean that is. You can see your opening quantity, what you bought, what you sold, and what you're left with for every single stock. Instant clarity.
We can also zoom right in on a single trade. This simple bar chart tells the whole story of our ITC shares at a glance. You can see what we paid, what we sold it for, and right there at the end, the net gain. It's just a super simple visual way to see the result of an investment. And by pulling all this clean data together, we can start building high-level views, like this portfolio snapshot. This is where you get to see the big picture. You can see how much of your profit is coming from short-term trades versus long-term holds, and even see how much potential profit is still sitting in your current holdings. So what this all really means is that by following these straightforward steps, you completely transform what Tally is for you. It's not just a boring bookkeeping tool anymore. It's a clean, powerful, and insightful dashboard that you can use to manage your entire investment portfolio. And that really brings us to the final question. You've done the work, you've achieved total clarity in your numbers, and your books are perfectly balanced. The real question now is, what are you going to do with all that clarity? How will you use these new insights to make sure your investment strategy is just as balanced and successful?